Hello, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be back with everyone today. A few disclosures to begin. I'll share a few links also in the chat, including links to our trading view ideas. I'm going to check that out. We did one earlier in the week on gold. It's pretty interesting. It had lots of movement this week, but gold did also work. I'm just looking now, and the euro continues to push higher. Uh, and It's interesting to see this continued weakness in the US dollar, despite the market being highly volatile. It does suggest that some of the bigger trends we've been talking about for a while may be more lasting in nature. And I'm talking about trends of essentially people avoiding US assets overall, things like gold, things like the euro doing well, and then things like, obviously weakness in equities overall. So we have a highly volatile market, and I'm going to be kind of covering some of those things, but first show you some standardized returns here. To me, the bigger thing about the volatility is just to kind of focus on, our volatility cycle. We have this idea that when the market is, volatile and correlated, it makes sense to focus on the indexes and shy away a little bit from individual stocks and things like that. So we're kind of keeping that theme and working on some things that kind of help with the indexes and in particular the index futures, because those can be one of the more kind of useful things. A market that's more active like this, levels come out of nowhere. You have a big move here or there, something happens, then before you know it, things reverse on you. And we have some tools to show some of that. Now, before we do that, I do want to remind people that it is earnings season, or at least earnings season starts very soon. So if we go here to the earnings date tab on our MT main workspace, we can go to data, import or add symbol list, and import the S&P 500. I'm going to just do that very quickly. This will now build a dynamic real-time calendar for me. Now, also, remember, if you go to tradestation.com here, and then you go to our, sorry, I should have, on the homepage of TradeStation, you scroll down, we have this article here, Tariffs slashed after bond freakout. This is the article that has more or less a rundown of what we're doing in today's webinar, if you want to look at some of these points. And it was pretty interesting because overall here, so we actually have some links up here, including a new workspace that we're going to share with you guys called MTES version 2. So the downloads are here. You go into the downloads if you don't know how to do this yet, and you first want to get the ELD files. You want to import those indicators into TradeStation's platform, and then you can open the workspaces, and it allows you to see some of these special indicators I'm now sharing. So it was very interesting to me is, we basically on Monday, we just started the market. We focused really on the indexes and sectors, and we had kind of talked about the potential of a push toward the September level around 5,400. It went about 1% above that yesterday, and more or less stalled. And we had also been kind of looking for it to hold this kind of 49.50 area, and that's pretty much exactly where we rallied off of from the downside. So 49.50 now kind of have this range up toward kind of 54, 5,500 ish. Now, in the chart we did here, it's not super clear here, but if you look in the blog, it's roughly a 50% retracement of the entire drop that we had all the way from the high all the way to the low, depending on how exactly you want to see something like that. So one thing that I'm kind of wondering now is, we did a trading view idea when we said, is 5,700 right here the new 6,000? And now we might have a little bit of a question of, is 5,500 the new 5,700? And what I mean by that is, you could see at this point, we basically had this support, this old support level, this low from early January, went over here and became the high. Then we go over here, and this support level from early March may have just become the low. And what's also interesting is, what was this level from March, and then also right before the rebound of last week. So this is now setting up for some things where it looks like we have some pretty clear structure of lows becoming highs, and now we have a second one. So this, in many ways, is kind of the definition of a bear market, or at least a downtrend. And so I want to mention that. Now, what is interesting is one of the indicators that we actually have available to you guys is on MT breadth. Is one of the other workspaces in the zip file. Is we have these special indexes, these TradeStation index showing the number of stocks above and below certain moving averages. And we actually went down to something like, at one point, there was only like 11 stocks or something above their 20-day moving averages in the S&P 500. That is, if you look at it historically, an incredibly low number, and it tends to show a period of actually oversold conditions. And that's an interesting thing that kind of popped up. So some of these workspaces have some other interesting tools in them, and I wanted to just kind of point that out. All right, so all right, at this low this week. All right, here we go. Just six members of the S&P. It was just six. And that is basically, if you look on a long range, that is like almost unheard of historically, even during things like the COVID sell-off. We also see here that Wilder's RSI. I don't have it. Yeah, I have it on this chart, but this was the lowest level really in a pretty long time, since February of 2020, at the beginning of the COVID sell-off. And this will actually raise something that I don't want to get into too much here, but divergence is now a way to be thinking about things in terms of where the market may be bottoming. I don't want to actually pull up the chart, the RSI on it, but what I'll say is, say the market, like, so we look here on the kind of daily chart of where we are in terms of, kind of came back down this range as an inside day, but what's interesting is that, if the market were to continue lower, for example, in some ways, if there is a bottoming process, one of the signals, and this could be months away if this is really the case, one of the signals for a bottom could be the fact that we see RSI make a higher low. In fact, I'm going to just bring it up because I love showing charts. But basically, RSI can make um, a higher low as the market makes a lower low. Also, for example, what people might want to be looking for is the same thing with the VIX. Will the VIX make a lower high when the market makes a lower low? If you go back to other periods of bottoming, like, for example, I know 2009, the VIX made a lower high when the market made a lower low. Another thing that happened, for example, in 2020, was RSI made a low in February. The market continued lower in March, but RSI never reached the same kind of oversold condition. So that's kind of what we have. I'm going to just show this because RSI can be really interesting. Um, all right, so while that's loading, let me just look back at anything else here that's really important. But I also think it's important to realize with the VIX well above 20 now, this is in some ways a different kind of market than we've seen before. And we've talked in various times about the pullbacks that we are having were much deeper. We talked several weeks ago how we pulled back and revisited levels from 6 to 9. I think it was about, something like 6 to 9 months prior. And we had never pulled back more than, say, 2 months at a time in terms of the low was the lowest level in so many months. So the thing is that we are seeing some kind of, this is something now where I think definitionally we can say that it is at least an intermediate term bearish market, a bear market. We had the 50-day moving average coming down pretty quickly and threatening to go under the 200-day moving average. So you can now just brace for CNBC and all these other people's market, whoever, if you ever read any of those other mainstream news organizations, you're going to see death cross in the S&P. Well, that might be happening soon if you actually look at it. But here's the RSI I want to just kind of point out. And so this was the lowest level in a long time on Wilder's RSI. You can see right here the low that it made. So, you look at this only goes back 1 year, but this is something also where at this point, look at the low here, and then this makes a lower low. So in some ways now, this is still confirming that a downtrend in some ways remains in effect. And I think we have to realize, if you look at it on this chart, you can kind of see here, this level looks, kind of a zone right around kind of 5,400 up toward, the 5,400 goes back to September, but then you also have this level from right here. And you know what, if we take, if we do the Fibonacci retracement, let's go to drawings, and Fibonacci price retracement lines, and we go pretty much from the high down to here. You can see that 50% was just above yesterday's high. So, again, these things are confirming here that, or at least, kind of potentially giving a suggestion here that we are now in a market that is basically in our volatility cycle. That we're here. We're in this area here where indexes are all your opportunity, and more correlation and individual stocks are not going to be very helpful, and not going to make a lot of sense. And so in many ways, now's the time to be kind of thinking about the index, the correlation, the futures trading, and less of the sort of stock stuff. And that's kind of what I've been kind of doing myself. I've been focusing on the indexes, and I'm going to show some of these things in a second. Let me just look here to make sure there's anything else in this I wanted to mention. Also, what's interesting is that over here on this chart in Trading View, we've talked a lot about the 10-year Treasury yield, and we have this level at 4.32, which we have identified as potentially important. It actually goes back to June of 2008, and it was in many ways a line in the sand, of the financial crisis. And we had talked, I believe, on Monday of this week, and we said the biggest risk this week was going to be the 10-year Treasury, and then we had that huge rally, or the huge sell-off in price, upside in yield, yesterday morning. So in many ways, these are the sort of things. Remember, we do Monday, we do our state of the market webinar. State of the market, we look at the indexes and we look at the sectors and we look at things like Treasury yields. And in many ways, this is exactly what we were at the time. Actually, I want this on the weekly chart. Sorry. We were pointing out this pattern on the weekly chart. And, we're also aware of the fact that this has been in a long term. You look at this on the monthly now, this has been a downtrend basically for, decades. And in many ways, COVID potentially marked the end of that. And then in early 2022, we broke through it. And now we seem to be making higher monthly lows above these old levels. So look how we threw that level from 2018 all the way back in 23, and we held. Then when the Fed started cutting rates, we still held above it. And now you look, and we're making this kind of high basing pattern, above 4%. And this level from 2008, it goes back. If you actually look on the chart, it's over here from this level. This was when like the real ugliness of the financial crisis started. It was June of '08. And then basically the yields were lower ever since. So to be back above that level is I think potentially important. But the key thing is that we are above this level here from November. So you can see we've been stair stepping higher, finding support at higher lows, going back. It's just like kind of going back in time, walking our way back up that we stair step down. And from my perspective, this remains the main item we have to be aware of, because if we continue to see the upside in Treasury yields, then it's a hard argument for multiples, and everything else becomes problematic, in terms of. And I continue to believe that housing prices will not really reset if rates stay high, because it prevents the washout in the housing market. It prevents the big bunch of sales that will then mark down prices. It also prevents people from moving and exiting apartments, which will crush rents. One of the things, I remember I used to have a condo in Jersey back in 2006, and I was lucky to sell it near the high of the property market. And one of the reasons why was because my tenants left it, and I tried to put it on the market, and I could not find a single tenant. Why? Because at that time they were giving mortgages away and everyone wanted to buy houses, and basically rents collapsed and you could not find any tenants. So the thing is right now there's demand for apartments, and until we see mortgages come more in line, it's going to be difficult to really see that sort of opportunity when people start walking away from apartments. And so I think that's just a dynamic way to remember. And for me, this remains a structural problem right now, a catch-22, where higher rates are not necessarily going to be, disinflationary. And I think we really saw something of that today. I'm going to get to it. I'm not ready, but there was something in the CPI report that was potentially not particularly good. Let me just see if I have anything else in here I need to cover. Talk about the fact that the 10-year yield made a higher low, while the S&P makes a lower high. That's what we said. Lower high, 5,500 is the new 5,700. Meanwhile, on the 10-year, 4.2% is the new 3.8%. Okay, that's kind of what we mean here. So we showed the oversold condition. I mean, overall here, you can kind of look into these things with tariffs. I mean, for me now, we're kind of in a reality where everyone knows what the narrative is now. And I think that, what was interesting is that, well, I'm going to actually get to the macro. Let me just focus on the overall indexes first, because I do want to focus on really the S&P a little bit more here. I had some other points I want to make. Basically, let's look at the futures now. So if you look at the top of our blog post here, we have this new workspace available to you. And I don't know what's going on with, my computer. Like I said, ever since they updated Windows. Anyway, so this is a new workspace. So here it is. This is MTES version 2. I added 2 more charts to it. Let me hide myself so you can see the chart. And basically we have some new charts. This is the 4-hour candles on this chart. And so what this shows is this basically shows price channels, and you can see how much is opened up. And I'm not always sure how much I care about price channels. I've used them, and I left this on the chart because sometimes they seem to be useful. I mean, you can look like right here, it gave a really good signal. And the main thing I want to talk about here are a few other things I did. So this shows the 10-day simple moving average. So what I did was I basically figured out on an hourly chart of ES how many candles are there in a day, and then I basically multiply that by 10. And this will mimic the 10-day simple moving average. And I did the same thing on the cash index. So it's a different number. I think it's 70 hour, which is essentially a 10-day moving average. Now, I am a believer in the 10-day simple moving average. I believe that it moves nicely in a certain direction, and it can give a really clear sort of signal on direction of the S&P 500. I don't know a lot of other people who use it, but I have been able to use it effectively. And so that's one reason I wanted to include it on these charts. So for me, I think the thing is, you see this big rally, but then at the same time, that falling 10-day moving average is kind of like a splash of cold water in the face, kind of a wake-up call that, you know what, we are in a downtrend. And so I think that's kind of something here that's useful to see on these charts. Now, this is the 1-minute chart. But so just quickly, this is the one you guys already know that we have signals on. This is the one where basically we have the hourly chart of the S&P 500 futures, and it has the 50-hour moving average, and then it has the moving average speed down here. And then what's interesting is we've mostly focused on moving average speed and stochastics for our signals. But the way I designed this, there are 3 signals, and typically you would want 2 of them to give you an actual potential entry on the long or short side. So the other signal is MACD. What's interesting is MACD is rising, that's considered bullish. 50-hour moving average is rising, that's considered bullish. So basically what's interesting here is, see how MACD started rising and the 50-hour was rising? That actually gave you some sense of the potential upside that was coming in the market yesterday. That doesn't mean that it would have gone up that much purely on its own, but it does actually give a signal that there was some upward momentum in the overall index here. So here we also see something where the 50-hour is rising and stochastics went oversold, and we got something of a bounce. So that's also just kind of telling you something here. If it's much more of a bounce, I'm not really sure. I wanted to just kind of mention that these are the way the signals work. It is also interesting that MACD overnight started falling at the same time stochastic was overbought, which also gave something of a bearish signal. So I wanted to mention that. I also wanted to mention that if you look at the high we had here, it was very close to the lows back here on March 31st, and kind of the gap down on April 2nd, after Trump announced the initial set of tariffs. You can see here in the daily that we're just slightly lower, which is really interesting. These things are all kind of giving some signals that a downtrend may be in effect. So I did want to kind of point that out here. Is that this is some of the ways that futures can be kind of useful. And the other thing is, because they're open around the clock, there can be opportunities sometimes when they give a kind of zombie drift, and they might just go to some nice levels and then have some opportunity. So it can be kind of interesting to kind of be really nailing levels. Sometimes in the overnight session, you'll get certain kinds of activity. It's also interesting, and I'm not actually sure of this yet, but it can be interesting to look at European trading hours, because sometimes when Europe opens, you're going to start to notice that these things start to move. All right, so that's just kind of something I want to mention there. Another thing about futures that can be potentially interesting is the fact that they don't have implied volatility, which means that if you want to trade options in a time of high volatility, those options are more expensive, and it's harder to generate leverage. So the thing about futures is they always trade the same in terms of their pricing and stuff. So it's another thing to think about with futures. The last thing I'm going to show you is the 1-minute chart that I've created here. Now, what I did with this chart was I basically put on an indicator that will show when the candles will show when it makes a new high in the last 15 minutes. So this will essentially mimic 15-minute candles on a 1-minute candle chart, and it will kind of show you when it starts to kind of make new highs on the 15-minute chart, which I've kind of found to be somewhat interesting. I find this on the 50-minute to be, I have found that when it's moving in a single direction, it can give like these sort of entries you'll see. But the thing is it then when the 50 minutes starts rising, and then you can see here you started getting these lines, these crosses, the 15-minute high that actually told you that the 15-minute chart was now starting to make new highs. So this gave you a potential signal to the downside, and this gave you a potential signal to get out. So that's just something to to kind of look at some of the ways you use these things. Now this is very active. This thing dropped basically from 53.30 to 51.60. So if a person had been, I can't even think. I mean, basically with a single contract, if you short 20 points is $1,000. So if a person is shorted a single contract, they would have made over $5,000 in this move. So just to be something to be thinking about. That I want to just kind of show you guys. This is just these are some of the tools I've created. Now remember, the point of all this is that when you're in a highly volatile market, levels will come out of thin air. They'll have violent reversals. They'll be true for like a few hours, and then they're never to be remembered again. So levels are important, but in many ways with this kind of futures trading, you get these short-term signals and you get very big moves around these relatively small sort of rotations. Which also another signal here I want to point out is that it made a higher low. This was another signal here. So if you look, the 50-hour was rising and it made a higher low. So that was another thing that kind of gave a potential signal. Now, I could add to this, which I'm not going to do right now. I could add if it makes a new low in the last 15 minutes, it would actually show the candles on both sides. That's another way to kind of think about it. So it's interesting to be thinking in multiple time frames, and some of the tools we have on TradeStation make that not terribly difficult. This indicator here is actually a show me. It's not a study. It's called breakout of X bar high, and you can see it's set to 15. There's another one called breakout of X bar low, and that will show you if you've made a new low in the last 15 minutes, and that will be the same thing as the 15-minute chart making a new high or low candle. So these give you some potential signals. I wanted to just kind of show that because you can be pretty creative with some of the future stuff. The one last thing I'll say is that these should not be changed because SPX is basically a cash index. It's different, and the intervals are set a certain way. So changing the intervals on these will mess up the logic behind them. Just so you know. All right, so I wanted to also quickly mention as I look at the overall market here, is that for me, one of the things that is kind of, I mentioned on Monday in State of the Market that we might actually be entering a secular bear market. And I want to just kind of just mention that a little bit more because I think we have to entertain this possibility. If you look on the overall S&P, in fact, I think I'm going to go over here, MT Main, and you can see my earnings calendar populated. But if we go to key ETFs, you can look at the moving average order. Look at does anything have the 5-day above the 10-day? I don't think so. Even gold miners don't have it. The only thing that's positive year to date is gold miners and Brazil. Think about that. And these Chinese internet stocks, which is interesting. Actually, I'm sorry. We also have consumer staples and utilities are barely squeaking out a gain year to date. But the thing is, this is kind of showing us here that we don't really have anything with really very much positive short-term momentum, which means that there will be counter trend rallies. But at the same time, as long as we see the 5-day under the 20-day or the 8-day exponential under the 21-day exponential, those sort of short-term trend indicators, those continue to give a bearish picture and an overall negative sentiment. The high volatility, the high correlation, these are all things that can kind of help give us a sense that this is not necessarily the market that we had 6 months ago. So it is possible to say it's a secular bear market, and the reason I say that is, first of all, well, it's interesting. Jeremy Siegel today on CNBC, he's just a pretty mainstream sort of guy, but he's been around for a while, and he knows a thing or two. And he basically says that he doesn't think we're going to see the highs in February in a long time. Now, another argument on that is that multiples still remain pretty high. And the other thing is that earnings estimates have been coming down. They've been coming down pretty sharply. If you actually look, these are published every week by S&P. There's an analyst there who puts them out, and I look at those, and earnings estimates continue to come down. So the fact is that we expect that strong earnings growth this year. That was what the forecast we're looking for. It's now weakening. There's a good chance it will get weaker, and multiples are still relatively high. So if you're trading at 19 times earnings, but maybe those earnings are not, maybe that growth you expected is not going to come through. If you're trading at 19 times earnings and your forward earnings growth is flat to negative, 19 times can look pretty expensive. And I think people are in that spot where we're recognizing that now. Now, in terms of the secular bear market idea, the notion, and I want to just emphasize that, I will embrace a concept, and while it's working, it works, and when it doesn't, it doesn't. So I just want to make sure I'm not making any kind of call or anything like that. For me, it's all about the narrative. What is the mindset of the market now? And to try and identify the narrative, to identify the trends, because that's what we do on market trends. So the trend that now I think is taking shape and people are getting an awareness of is the idea of this kind of maybe more lasting secular bear market. And so think about some of the things here. Earnings coming down. Earnings are weak. That would be consistent with a bear market. The idea of valuations being high. And I have said this before, but we got more of it today. The anti-Goldilocks. So what do we see today? We see jobless claims continuing to be low. Is the Fed going to cut rates when jobless claims are under 230,000? That is a problem. So what I've said is maybe not a problem if if you have a job and that's all well and good. But if people want to see the Fed cutting rates and the market just going higher and everything being all happy days are here again, it's going to be difficult to justify rate cuts with jobless claims so low. And we've been saying since early in the year that we see an environment here potentially that is the anti-Goldilocks. The jobs are too strong for the Fed to cut, and inflation is too high for the Fed to cut, and the overall economy is too bad for earnings growth. And simultaneously, when you throw in things like tariffs and what that does to cost structures, it in many ways threatens earnings across the entire universe of the S&P 500. So, weakening earnings, higher interest rates, higher inflation. It's the anti-Goldilocks. That is part of this potential concept that there may be being a new secular bear market. But I think it's also that we had massive fiscal stimulus in the previous administration, and that has been kind of fading. There's even some risk of some of this massive factory investment that was done, some of this industrial investment might have to get written down even. We have uncertainty about things like the CHIPS Act. There has been signs of the data center boom fading. The rally in gold. We're seeing also, if you look here at the U.S. dollar, look at the dollar index on TradingView here. I mean, this is something. Wow, I hadn't actually look at this. These lines that are getting just, to me, this is actually something on the monthly chart. This is something where people might look for further downside in the dollar. Normally, dollar going down should be bullish. It means risk on, but in this case, between dollar down and stocks down, it says that money is leaving the United States, leaving U.S. assets, and that is not necessarily bullish for U.S. Things. It looks maybe it's a little bit like the 70s. Look at names like Apple, Alphabet. I mean, Alphabet to me, I look at and it's like since I started using ChatGPT and AI, I use Google like half as much as I did before. Things like Apple have risk from things happening with obviously importing iPhones from China, but on top of that, the fact they're losing market share potentially in Asia. So these things create risk. Things like Amazon, tons of their merchandise is exposed to China. So I think it's important to realize, I wanted to get to this. What did we do by changing the tariff rates? In many ways, by raising the tariff on China, which is our number 2 trading partner, at the same time we lowered them on other countries. The news that the White House made yesterday really only represented a small decrease in net tariffs. And a few people have done different calculations of this, but the basic thing is by raising tariffs above 130% on something like China or 125%, essentially this idea now of blocking items from China. I mean, that is something that is going to create major problems for earnings, major problems for products, major problems for inflation. And in many ways, if you look at it, the real winner in this is going to maybe be a country like Vietnam, because now the shoes they make will be more expensive and they can import to our market, while at the same time they're going to make more money on their shoes, and maybe some products from China will even sneak through Vietnam, like happened back last decade. And so all these sort of things can be kind of happening, but ultimately it's not good for companies overall. And if you look back to the 1970s, we had a similar pattern. The Nifty 50 stocks then. Now we had the Mag 7. This idea of leadership was concentrated in a small group, and we had this sort of idea of
of market cap as a percentage of GDP hit a similar peak. And so I think all these things right now, it creates a plausible thesis that we are in something of a more lasting bearish phase. And if that is the case, it does make sense to be kind of sharpening the futures game, focusing on things like futures in the indexes, and thinking less about tech stocks and those kind of growth stories and things. What I also think was interesting when we look overall at just some of the news and stuff today, look at CPI. What was troublesome to me was that shelter went down, yes, but owner's equivalent rent did not. Shelter went down because demand for hotels is apparently collapsing. We saw a drop in shelter for accommodation in hotels, but rents and owner's equivalent rents went up from zero point 0.3 to zero point 0.4. That is not, we need to see that go to like zero for CPI to really sustainably stay lower. And I think as we move into this summer and as we move into back to school shopping, the knock-on effects of these tariffs can be bringing inflation back up. And I think that's something that's going to be out there. Auto prices also fell. Will that remain the case with what's happening with tariffs? Not so clear. So I think these are just the overall things that we're kind of seeing here. And I think that the market sees them as well, and we're in a different sort of environment. The last thing I want to point out is that the semiconductor index SOX, we had talked at, let's go to the weekly here of SOX, but we had talked about this really important level that we had broken under, and look how we came right back up to it. So it can be good to have a single chart that you just put lines on and you just look at it like once every day or, a little bit and kind of keep your lines on there and kind of notice, oh, wow, it's interesting how on the daily we just basically went under it and sat and then broke under it and went right back up to it. So I think these are also kind of consistent with the sort of thing we're talking about. The fact that the old low becomes a new high on semiconductors, which is such an important part of the market. So those are the main things that we've got here. We're going to be doing state of the market on Monday, and we will not be doing market trends. I'm sorry, this is not correct. The 17th. The next market trends is after Easter. Not going to do it on next week. So we'll be doing State of the Market on Monday. Hope everyone has a great weekend. Check out the new workspace, and I'll see you guys on Monday. Have a great weekend.